So you've heard of investing your money either through someone you know, on the internet, or even on the news, and you wonder how it works and why you should do it. Well, today is a perfect opportunity for me to guide you through what I believe is a complete guide to investing into the stock market. This still is a pretty taboo topic, not a lot of people are gonna speak about this, but this can literally change your life over the long term if you start investing right now. So stay tuned, let's go through it. We're gonna start with a simple explanation. What is the stock market? Well, the stock market is a place where public companies allow people like you and me to buy what's called a share of their company. A share is a part of that said company that you can buy and sell on the market. When you purchase a share of a company, you become owner of a company. And I know it sounds crazy, but for example, if you buy a share of Apple, congratulations, you are now an owner of Apple. Hello, my fellow Tim Cook. Now, why do we always hear people speaking about the stock market? What's the deal with that? Well, quick answer is because you can make money out of it. And let me explain you a few ways that you can use to make money in the stock market. Let's continue with the example I took before. You want to become Tim Cook, so you bought one share of Apple in 2019 at a price of $37. Then over the next 2 years, Apple continued producing new iPhones, new Macs, new gadgets, and overall their sales increased in the entire world. They made a ton of money over time and the company grew quite a bit. And because of that, the company is way bigger than it was before. With that, the price of the share that you bought at $37 grew to about $145. So if you bought this share in 2019 at $37, it will be now worth $145, which means that your money will be 4 times higher than it was before. So over time, the price of a company most likely go up as their business grow, and that's how you can make money out of it, because then you can sell these shares for profit. So buying good quality companies at a certain price, holding them for a period of time and then selling them is a way for you to make profits, but there are other ways that we're going to speak about in a bit later. Now, this sounds really nice, I know, but what is the catch? Why don't you just put your money into a savings account, for example, because you are still making your money grow, right? Well, there are multiple reasons for that. The first one being that savings accounts, for example, have a really low yield, which means that your money grow at such a slow pace that you can't even compare investing in the stock market with having a savings account. Now, on average, your money will grow about 0.06% per year by having it sitting into a savings account, which is just ridiculously low. When if you invest into the stock market, on the other hand, you can get much higher percentages, so that's the first reason why people invest in the stock market. The second is inflation. If you guys have never heard of inflation, let me put it into simple terms for you. The money that we own over time will lose value because the price of life gets more expensive. Look at what you're buying right now and look how much it costed you 5 years ago. The price definitely went up over time. And that's inflation. The prices go up over time while your money don't go up over time. So your money loses value every single year. And on average, inflation is about 2 to 4% a year, which means your money loses 2 to 4% of its value per year. And I don't know if you understand, but that's a lot of money that you're losing. So if you just place your money into a savings account, as we said before, with a 0.06% growth per year, and on the other hand, you lose 2 to 4%, you are definitely losing money by placing your money into savings accounts. And the third reason why people invest in the stock market is because you can customize where your money is actually going and which company you're helping financially. Let's say that you want to change the world by investing into renewable energies. Well, you can just do that by investing into companies that are working on renewable energies. Or let's say that you're a fan of electric vehicles, you can also invest into electric vehicle companies. It really is a way for you to put your money where you believe the future will be. And it's really important, especially if you want to invest into innovations and future technologies, for example. And this is a way for you as an individual to actually change the world over time by helping companies that you believe will be very useful in the future. Now, before going into the really juicy stuff of this video, please consider joining my Discord server down below in the description of this video, and you can also support my work by buying me a coffee on my Buy Me a Coffee page that you can also find down below. Thank you, and let's go deeper into this stock market video. Okay, since we have cleared out how the system works and why you should invest your money in the stock market, let's speak a little bit about risk, because it's really important. You don't want to lose money by doing this, and I'm gonna show you actually a way for you to almost completely eradicate the risks when investing your money. So please stay tuned until the end, that's really important. Of course, if you invest into a company that is doing poorly, the price of the share that you bought at a certain price will most likely go down with the company For example, losing revenues or losing growth over time. So yes, you can lose money by investing into a company if they're doing poorly. So this is why you should choose really carefully which company you want to invest in, which sector are you interested in, and all that stuff that we're gonna speak about a little bit later. Of course, there are many different degrees of risk that you can use in the stock market. For example, if you just buy a share of a company and the price go down, of course you're losing money, but that's still a really small amount. There are other ways, for example, to leverage your money, things that you don't want to use as a beginner because you pretty much have infinite losses on these things. So please just stick to buying shares of a company for now, and we're gonna speak later on about leverage and why you should not use it. Now, before speaking about how you can reduce the risk to almost zero, let's speak about another way that you can use to actually make money in the stock market, because I told you before, there are multiple ways for you to make money in the stock market. And let's speak about dividends. The way a dividend works is when a company is having so much money that they don't even know what to do with it, they have enough to reinvest into the business, and they have this surplus of money that they have, they can choose to give it back to shareholders, so people that bought shares of the company, in forms of cash payment that we call a dividend. A dividend most of the time is expressed in percentages, so a dividend yield, for example, a company that has a 3% dividend yield will give you each year 3% of the value that you invested in. And what's really cool about dividend is that it can be considered as passive income, since you don't have to do anything to receive these dividend payments except one time buying a share of a company, and every single year, as long as they pay a dividend, you're gonna receive these cash payments every time. Let's take a quick example. Let's say you have 10 shares of a stock that is worth $10 a share, so you have a $100 in investment. And let's say that the company you invested this money in has a 5% dividend yield, which means that every single year that you're holding onto these shares, you're gonna get $5. You invested $100, so you're gonna get $5 a year just in dividends. It might seem like a really small number, but keep in mind that this is completely passive. You're just investing into this company. Even if the stock price doesn't go up over time, you're still getting 5% per year with this dividend. And also think about the fact that this can grow over time, right? It can go to 5 to 5.1, 5.2, 5.3. Over time, this dividend can grow and you're gonna get more money to your name. And also don't forget that the price of the share also can go up over time, so you're making money with the dividend and with the stock price increase that you can sell at the end. So if you invest into dividend companies, you can make money with the dividend payments and the stock price increase, which is really cool. There's also something called compound interest when you reinvest this dividend into the companies, but I'm not going to speak about it today. I got other videos speaking about it and future videos that will also speak about it later on. So don't forget to subscribe if you don't want to miss these. Okay, now the tricky question: which company should you invest in? And why is it a tricky question? Well, because there are multiple answers to it. In most cases, you actually don't want to invest into an individual company. What is an individual company? Well, every single company that is listed on the stock exchange is an individual company. Apple, Microsoft, Tesla, Facebook, all these companies are individual companies, and why would you not want to invest into them? As you've probably already heard, don't put all your eggs in one basket, and that's exactly what you do when you invest into an individual company. Let's say that you really like Apple, you put all your money into Apple, and next time, for the first time ever, pretty much, Apple is doing poorly and the stock price goes down. Or let's say that they have a big scandal with the product and the prices go down even more. Well, you are now just in a position where you don't have any more money to invest into this company that just went down, and you lost quite a bit if you sold these shares. Or let's say that you're investing into a company that goes bankrupt, you just lose everything that you invested into this company. So let me introduce you to the magical world of index funds. Index funds are made of two things: an index, which is something that follows something value-wise. For example, it can be an entire economy, a specific sector, or just a few companies. And a fund is something that you can put your money into it. So an index fund is a way for you to put money into something that follows an index. And I know it can sound like Chinese, but let me give you an example so you can understand. The S&P 500 is an index fund that follows the 500 top performing companies in the USA. So why is it better to invest into this rather than individual companies? Well, because since your money is split into 500 companies, you are diversifying your portfolio, which means that there is way less risk and lesser ways for you to actually lose money. Because if one company goes bankrupt, well, that's okay, you have 499 others to back it up. And this index is always changing. If a company is performing poorly, they're gonna go out of the S&P 500 and be replaced by a new one. So the S&P 500 can't go bankrupt. The only way for you to lose money if it's the entire entire US economy goes down. And on average, the S&P 500 is growing about 10% per year over the last 10 years. So that's the kind of return you can get by investing into the S&P 500, which is mind-blowing in my opinion. So the best way for you to invest your money over the long term is to invest into these index funds, and you can do that by buying what's called an ETF. That is just a stock that follows an index fund. For example, you can buy an ETF following the S&P 500 and you'll be good for the long term. But before you go and choose your first stock or your first ETF, go and watch this video right here. That's gonna help you out a ton to choose your first sector, first companies, first index fund to choose from. I really hope you enjoyed this video. Subscribe for more content like this, and I'm gonna see you guys in the next one. Bye bye.